Let's now get Kevin O'Leary's thoughts on what the CMHC is telling us about the Canadian housing market. He, of course, is chair of O'Leary Financial Group, joining us from Muskoka. Kevin, good to see you. Thanks so much. And let me get your take. What do you think of what they're pointing out, that there are increased risks? What do you make of that? How do you interpret it?
Yeah, I read the report. I was surprised that Vancouver wasn't on the list of overvalued, but their metrics made sense. But you know, Catherine, one thing we've learned over the last 10 years in housing in Canada, which has been a remarkable period with no correction at all, is that reports, government officials, even the finance minister himself, Flaherty, God bless his soul, no matter how much he jawboned this market, it didn't make a difference at all. Reports don't change valuations in housing, markets do. And so we have this remarkable period where the Bank of Canada continues to actually keep rates at basically zero. And housing's been an asset class that is always dependent on interest rates. So I don't really, not to disregard this report, it's kind of irrelevant, because if you go and look at condo prices, for example, shoebox condos are a very good place to look at in the Toronto, Calgary, Montreal, Vancouver markets. Usually the cracks occur there first. The classic 440 square foot shoebox 2-bedroom condo, no parking. Prices range from sort of 175 to 450,000. I watch those every month. There is no change, no cracking in pricing. Lots of units, 86,000 coming on the market the next 36 months. The demand for downtown housing in all Canadian cities is insatiable, because millennials and people that are moving here don't want to live in the suburbs or even own cars. So the report's interesting, but kind of irrelevant.
Well,
it's not going to change the market.
Well, what will change? I mean, what is the biggest risk? What are you say there's no cracks in the condo market, and that's what you're really watching closely for. I mean, Kevin, you and I both know, whether it's the equity market or a housing market, there's no cracks till there's a crack. And that's what we're all really trying to figure out, to make sure that people, quite frankly, are protected and have planned for it. So what's your sense in terms of what we will see?
Well, what I liked about the report is it tried to put metrics around each market in judging the risk. And of course, if you're preparing a report like this, that's a good thing to do. But in the history of investing in real estate in this country over many decades, as I have done, I've never seen a situation where one city corrected 20% and it didn't hurt all the other ones.
Right.
So real estate's an asset class that's interlinked. So you can't tell me that Calgary's okay and Toronto isn't. I mean, to me, shoebox condos that are built like matchboxes, which are really crappy, when they correct, they're going to go down 20, 30%, and there's plenty of them. There's a lot of crap being built, but I have not yet seen any cracking in the pricing. And believe me, these are low-quality units.
So what are you watching for then?
I always go the same way. What I've learned just from history is the first crack is the incremental shoebox condo. The prices, they can't clear the building. They can't sell the units. All of a sudden, you've got some development in a major city. Take Toronto, something with 400, 500 units in it and 2 or 3 buildings. They can't sell it out. All of a sudden, they start to discount like crazy. That affects everything around it within 10 blocks, and that's how the dominoes fall. Hasn't happened yet. And everybody that works for me in my offices in Toronto and the companies I own equity in, none of them have cars. They all talk about, look, I can either buy it for $250,000 or rent it for $1,100, $1,800 a month and walk to work. I think that's what's different in this cycle, is the demand for these things. But listen, in 10 years, are the windows going to fall out of these? Absolutely. Would I buy one? Never.
But what about the overall housing market? Housing
market's been really strong, but you can't have a situation where condos are correcting 30% or 20% and have, you know, mid-priced homes, sort of 700,000 to $1.5 million, not correct at the same time, and McMansions, where I think the real risk is in all cities, these 9,000 square foot multi-million-dollar houses. I don't know who's going to live in those things. I mean, there's, to me, no demand for that stuff, but yet they haven't corrected. Look at Oakville. It's one of the most overvalued markets in Canada. Not even mentioned in this report.
No, it's not. And what's interesting, though, Kevin, a lot of people will say that the condo market is just so separate from what will ever happen in the housing market. It's interesting to hear that you say you completely disagree with that. You've got to make the connection.
Oh, canary in the coal mine.
Okay.
Always watch crappy condo prices. Shoebox condos are the first place the poo-poo hits the fan. That's all I look at. When I see that correct, I want to be out of REITs. I want to be out of anything that's, and look, so far, there's been no major correction. Catherine, we're into the 20th year in Canada without a housing correction.
I know.
You think at some point we're going to have one? I think so.
I know, I just want to share this one thing. I remember sitting on a trading desk in Chicago, and this was, the markets. So this was before the financial crisis. So one of my colleagues was sitting there and buying a place, a second home in Arizona, sight unseen. And that was absolutely the top of the market. Nobody was worried about not seeing anything and just buying it because, there was just so much money around and everything crashed. And then once Arizona was down and California and Florida, everybody said, oh, it will be contained. And of course, it just wasn't. Lots of lessons, right?
But I think the best way to look at it is this. While you have continued zero interest rates and mortgages under 3%, there's not going to be a correction in housing. It's when and if Canadian rates go up, this asset class will suffer. I don't know if it's going to be a 30% correction. We've certainly had them in the past, but maybe it just goes flat for 10 years. I have no idea. But would I be deploying more capital into real estate now? Not a chance. No, I was going to use a more powerful adjective, but because I'm in mixed company and I respect you so much, I'm being a gentleman.
Thank you, because I don't use those words either. Thanks so much. All right, we'll talk to you later, Kevin. Thank you.